All right, welcome. In the next few minutes, we're going to pull back the curtain on the single most important number in all of real estate investing. Seriously, if you master this one concept, you'll be able to look at any property deal with the confidence of a total pro. So let's just dive right in. Have you ever wondered that? How do those really smart, seasoned investors glance at a property and just know? They seem to have this gut feeling for its potential, while the rest of us are drowning in spreadsheets. Well, I'll tell you a secret. It's not guesswork, and it's not magic. They're just focusing on one specific number that cuts through all the noise. And that powerful number is net operating income, or as you'll hear everyone call it, NOI. You should think of this as the investor's secret weapon. It's the one thing that gives you total clarity and lets you evaluate any income property, whether it's a little duplex down the street or a giant apartment building. So, what is it about this one number that makes it so powerful? Let's break down exactly what NOI tells us and why it's the absolute foundation of smart real estate analysis. Okay, so what is NOI? In the simplest terms, it's the pure profit a property makes just from doing its job, renting out space. But here's the crucial part. It's calculated before you think about mortgage payments or income taxes. Now that might sound a little strange at first, but there's a really important reason for it. It isolates the performance of the property itself, completely separate from the owner's personal financial situation. And that's exactly why NOI is such a game changer. By stripping away things like the owner's loan or their unique tax situation, you can finally compare property A to property B on a totally level playing field. It's a true apples-to-apples comparison. It doesn't matter if one guy paid all cash and the other has a massive mortgage. With NOI, you're only answering one question: which building is actually a better business? All right, so how do we actually find this magic number? Now, I know when you hear the word formula, it can seem a little intimidating, but I promise you, this is about as simple as it gets. It's just a basic two-step calculation. Let's walk through it. The formula couldn't be more straightforward. It is simply your gross operating income minus your total operating expenses. So think of it like this. First, we add up all the money that comes in. Then we subtract all the money that has to go out just to keep the property running. That's it. Let's look at each of those two parts a little closer. So step one is to find the gross operating income, or GOI. You start with every single dollar the property could possibly make. That's all the rent, of course, but also any other income, maybe from laundry machines, parking spots, you name it. But, no property is ever 100% full 100% of the time, so you have to be realistic and subtract a little bit for vacancies or for tenants who might not pay. And that gives you your actual expected income. Now for step two, subtracting the expenses. And listen up, because this is the part where so many beginners make a huge mistake. Operating expenses are the costs needed to run the property day to day. So we're talking about things like property taxes, insurance, repairs, maintenance, the essentials. What we do not include are your personal financing costs, like your mortgage payment, or accounting items like income taxes and depreciation. Just remember, NOI is about the health of the building, not the health of your personal bank account. Okay, theory is one thing, but let's make this real. We're going to run the numbers together on a simple 4-unit apartment building. We'll calculate the NOI from scratch, step by step. Let's imagine that our little 4-unit building, if every single apartment was rented out for all 12 months of the year, would bring in $60,000. That's our starting line, the absolute best case scenario for income. But again, we've got to be realistic. It's pretty standard to assume a 5% loss, maybe because a unit is empty for a month between tenants or someone gets behind on rent. So 5% of our $60,000 is $3,000. We're going to subtract that right off the top. And just like that, there it is. After we account for that potential vacancy, our real expected annual income, our gross operating income, is $57,000. See? The first half of our formula is already done. Now for the expenses. These are the costs you just can't get around as a landlord. We've got our property taxes, insurance to protect the building, a little budget for repairs, and maybe a fee for a property manager. We add all of that up, and our total operating expenses for the year come out to $16,000. And now, for the final simple calculation, we take our gross operating income of $57,000, we subtract our total operating expenses of $16,000, and that leaves us with a final net operating income of $41,000. This number right here is the property's true annual profit before any financing. This is the number that tells us how healthy this investment really is. Okay, so we did the math, we have a number, $41,000. You might be thinking, so what? Well, this is where it gets really exciting, because that number isn't just about profit for the year. It's the key that unlocks the actual value of the entire property. You see, unlike your own home, an investment property's value is directly tied to the income it produces. And the way investors calculate this is by using something called a capitalization rate, or a cap rate. Just think of the cap rate as the expected rate of return for a property in a specific market. The formula is beautiful in its simplicity. The property's value is just our NOI divided by that cap rate. And this right here, this is the big aha moment for every real estate investor. Because of that direct link, it means that you, as the owner, have direct control over the value of your own asset. Every single dollar you can add to your NOI, whether you do that by increasing the rent, adding a new fee, or by smartly cutting some costs, it has a massive, multiplied effect on your property's total value. Let's make that real. Just imagine the typical cap rate in your area is 5%. If you find a way to increase your NOI by just $1,000 a year, maybe you add some coin-operated laundry machines, you haven't just made an extra $1,000. You've just added $20,000 to the total value of your building. That is the power of focusing on NOI. And you know, really understanding this concept and putting it to use is what separates the amateur buyers from the professional investors. It totally shifts your thinking. You stop looking for just a nice property and you start hunting for a financially sound business that you can actively make better. So let's wrap this up with the key takeaways. Number 1, NOI is your secret weapon for true apples-to-apples comparisons. 2, it is the ultimate vital sign of a property's financial health. 3, it is the lever you can pull to directly force your property's value up. And maybe most importantly, number 4, always be a little skeptical. Verify the numbers. Never ever just take a seller's expense sheet at face value. Do your own homework and find out what things really cost. And that's it. You now have the fundamental tool that professional investors use every single day to build wealth. So the only question left is, what are you going to do with it? Pull up a listing online. Make up a property in your head. It doesn't matter. Just run the numbers. You now have the knowledge to see the world of real estate in a completely new way. Go put it to work.